Let us consider one problem, a complete problem where we have manufacturing, trading and profit and loss account of a sole proprietorship engaged in manufacturing activity. So what do we have here? Opening stock of raw material will go to the manufacturing account. What is freight inward? The cost of bringing the raw material into the factory. It's part of the direct material cost. Freight outward is outward. Outward is what? The freight incurred to send the goods or sell the goods, and this is actually a selling cost and will go to the profit and loss account. Direct wages will go to manufacturing account. Now, direct wages and indirect wages will go to manufacturing account. Only thing is, this will form a part of prime cost. This will form a part of overheads. Sales will go to trading account. Travel expenses, profit and loss. Stationery, profit and loss. Salary, profit and loss. Factory expense is manufacturing. It's an overhead cost. Closing work in progress will go to manufacturing. Selling and distribution, of course, profit and loss. Electricity, telephone charges, profit and loss. But opening work in progress will go to manufacturing account. The closing work in progress will go to the credit side of the manufacturing account. Closing stock of raw material will form a part of raw material consumed. Rather, it will be reduced from the cost of purchases. Opening stock plus materials purchased less closing stock of raw material is raw material consumed. Opening stock of finished goods will go to the trading account, and closing stock will also go to the trading account. Closing stock will go to the credit side and opening stock to the debit side of the trading account. Provision for bad debts. Provision for bad debts should go to our balance sheet. Depreciation on plant will go to manufacturing, on office furniture will go to profit and loss account. Repairs to plant and machinery will go to manufacturing. These are all a part of the factory overheads. Scrap sales will go to manufacturing account but on the credit side. Purchase of raw material, of course, manufacturing and will form a part of the prime cost. Furnace oil consumed is manufacturing. Interest income will go as income in the profit and loss account. Return inward is sale return and will go to trading account. But return outward is goods we purchased which we sold. Goods we purchased is raw material we purchased. Therefore, this will actually go to manufacturing account and will be reduced from the materials consumed. Power and fuel will also go to the manufacturing account. Following are the adjustments. Finished goods worth 3,000 were distributed as free sample. So what will happen to this? This will go to two places. One will be the profit and loss account and the other it will go to the trading account credit side. Because finished goods of 3,000, they were not used for sales, they were used for distribution as free sample. Therefore, they will go out of purchases or out of cost of goods produced and they will go to the profit and loss account. Bad debt to be written off 3,000 and provision for bad debt to be maintained at 5,000. If bad debts to be written off is 3,000, this will go to profit and loss account and balance sheet because it will be deducted from the balance sheet. And provision to be maintained at 5,000. We already had a provision of 6,000. So the remaining 1,000. No, instead of taking remaining 1,000, we can do one thing. We have an opening balance of 6,000 to which you can adjust the bad debt of 3,000. So we get a balance of only 3,000 and remaining we need to maintain 2,000. Remaining 2,000 will be charged to the profit and loss account. Loss of goods Loss of finished goods due to fire is 10,000 and insurance company paid 6,000. We have discussed this entry before. For loss of goods, we would say whatever abnormal loss account debit to trading account. How much? What is the amount? 10,000. So the amount of 10,000 will be credited to the trading account to arrive at the correct gross profit. Thereafter, what would we do? We would insurance company debit the amount which the insurance company has agreed to pay and the amount which we cannot recover, profit and loss account, 4,000 to abnormal loss account, 10,000. This is how the entire final accounts would be prepared. Let us take a look here. To raw material consumed, you have opening stock of 30,000 plus purchases, add freight inward, less return outward, purchased return 4,000 less closing stock. Add direct wages, you get prime cost. To factory overhead, we have indirect wages of 10,000, factory expenses, depreciation on machinery, repairs, furnace oil, power and fuel. These are the factory overheads. When you add factory overheads to the prime cost, what we get is called the factory cost. Add opening work in progress, deduct closing work in progress, sale of scrap, there is a figure, the balancing figure that we get. This is the cost of production, cost of goods which have been produced and sent to the trading account ready for sale, cost of goods produced. Now, how is the trading account prepared after preparing the manufacturing account? We have the opening stock of finished goods. We bring down the cost of production 4,74,000 from the manufacturing account. Sales less return on the credit side. Then we have goods distributed as sample, which we will remove from trading account. Goods lost by fire and closing stock given, so that our gross profit is 2,61,000. So what have we done here? We have the opening stock of finished goods, we have the closing stock of finished goods, and we have got, just like we used to have purchase of goods in non-manufacturing concern, in manufacturing we really don't have purchase. Materials are purchased, goods are manufactured, and the goods are transferred to the trading account. The cost of production is transferred from the manufacturing account to the trading account. Additionally, we have free samples. Distribution of goods is free samples. Like we said, the entry would be advertisement account debit. So profit and loss account would be debited with this free sample and trading account is credited. Similarly, goods lost by fire, we have credited 10,000 so that we arrive at the normal gross profit. So that was the relation between manufacturing account and trading account. The cost of goods produced is brought to the debit side of the trading account. In the profit and loss account, we brought forward the gross profit. We've got interest income. We've put in other expenses. Freight outward is carriage outward, cost of goods sold, cost of sales actually. When the goods are being sent out, the freight or carriage expenses incurred. This is said to be carriage outward. It is taken to profit and loss account. Then we have travel expenses, stationery, salary, selling expenses, electricity and telephone. All of this come to the profit and loss account. Depreciation on furniture, advertisement. This is free sample. The same thing. Double entry. Any adjustment, there will be double entry. Any adjustment in the trial balance, any adjustment outside the trial balance will be supported with an entry. It will have an effect on two sides. Like in this case, The entry was trading account. The entry was advertisement account debit to trading account. So trading account was credited and advertisement account was debited. Advertisement transferred to profit and loss account. The provision for doubtful debts, new provision of 5,000, bad debt 3,000, less old provision, we get 2,000 which is additionally created. Loss by fire was the net loss after the insurance claim. So we get net profit transferred to capital account.